Good morning and welcome to this Wednesday, November 4th, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, I guess the big news is the U.S. election. It has come and gone, but it's not over. Still a few handful of states up in the air. Presidential winner has not been determined. We'll have to see how this plays out, whether it's going to take a day, a couple of days, maybe a couple of weeks, maybe it goes to the Supreme Court, who knows. But I will say this, it looks like the market is relieved that at least the election has come and gone. We're seeing futures up here in the US. We saw markets across the globe rally overnight. And so it does look like the market's going to get off to a good start. In particular, technology stocks are rebounding. They've been lagging here of late. I noticed yesterday that the XLK on a relative basis to the S&P 500 lost its relative 20-week moving average for the first time in a while. And take you and show you that in just a bit. But before I get into any of that, I do want to take the new folks over to Earnings Beats, just to give you a sense of what we do and some of the things you can do if you'd like to join our community, participate in some of the things that we talk about. Hopefully add a few things to your trading arsenal or to your investing knowledge. But you can subscribe. We have a free newsletter. All it requires is a name and an email address. Hit that subscribe button. We'll make sure we get that our EB digest out to you every Monday, Wednesday, and Friday morning. It normally arrives before the market opens. I know here as we move into November, I've been focusing quite a bit on seasonality. We had a article out this morning on a company that typically does extremely well in the month of November. So really good information. So added a little bit here recently on seasonality, but normally focuses on earnings, relative strength, sometimes predicting earnings reports, not always the earnings reactions, but the earnings reports themselves. I think the charts can tell us a lot about Wall Street and what Wall Street is expecting from each company when they report their earnings. And so if you'd like to learn more about how we approach the market, that's a good way to start. Just simply type in your name, email address here on our homepage, hit that subscribe button, and you should be good to go. If you'd like to subscribe to our service, this is actually a pretty good time. We've got a number of webinars getting ready to hit, especially our draft, which is where we draft 10 stocks for each of our portfolios. They're equal weighted, and we hold them for 90 days. So if you're somebody who likes, wants to be in good stocks, at least leading stocks within leading industry groups, but you don't really want to trade, you don't want to be watching the market all day long, I think it's a great alternative to being involved in the market. You can see down here our 4 portfolios, how they have performed. We keep this updated every day. Thanks to Abby for that. And you can see our since inception for each of the model portfolios outperforming the S&P 500 over that same time frame, with one exception. That's the income portfolio. And I can tell you it was one quarter back at the beginning of the pandemic. We actually had positioned ourselves in that income portfolio. We were at an all-time high, if you recall, back on February 19th. But we had positioned that portfolio a little bit more defensively. We actually had a real estate stock in there, I think a financial, maybe an industrial or two, I don't recall. But when we did pull back, which is what the whole idea of the defensive positioning was, when we pulled back in February, if you recall, those defensive stocks were the ones that got hit the hardest. So I thought we were making a pretty prudent move into defensive areas. It played out that way, with the market pulling back. Unfortunately, defensive stocks were the ones that were hit the hardest. So anyway, that was a big, I think we lost maybe 10 percentage points, 12 percentage points versus the S&P 500 in that one quarter. So outside of that, I think the income portfolio has held up pretty well too. But you can see the others easily outperforming the S&P 500. And if you study the market at all, you know that most fund managers, portfolio managers, hedge fund managers, all of those types of investment professionals really struggle to beat the S&P 500. So we're pretty proud of those results. If you'd like to find out more, if you want to know which companies are in those portfolios, you can join. We have a $7 30-day trial, and we refund you the $7. So anyhow, a lot of good information on our homepage if you'd like to check it out. Let's take a look at what happened yesterday in the market as we prepared for the election results, which came in across the country last night. Dow Jones Industrial Average gained 555 points. S&P was up almost 60. NASDAQ up 203. And one thing we saw early on, NASDAQ was underperforming. And then we saw the NASDAQ kind of make a little shift and start to outperform throughout the balance of the day. And perhaps we know why now with the technology leading in the futures this morning. Mid caps up 43 points, 2.25%. Small caps up more than 2.5%. Really big pop there. Both the mid cap and the small cap are actually close to making another breakout, which is good. I mean, we want wide participation in this bull market to the upside. So I don't care exactly who leads. We're going to continue to watch it here at Earnings Beats and try to figure out where the leadership is going. I just want the market and just about everything in the market to participate to the upside. That's the hallmark of a secular bull market rally, wide participation. As far as sectors go, yesterday we had industrials leading again. Been talking recently about how industrials love the month of November. You can say what you want. I'll pull it up in just a second and show you. But industrials love November. They've gotten off to a great start here in November so far. Financials making a push to the upside. They might get hit a little bit though today. 10-year Treasury yield is struggling. And I'll talk about that in a second. Energy, though, on the flip side, continuing to struggle at that 20-day moving average. Crude oil prices this morning are up more than 2%, though. So that could give us a lift on energy. Maybe we can get through that 20-day and have it stick, eventually get through that 50-day. We'd like to see this start to trend higher as well. Best performing industry group yesterday was autos. I don't know if you saw NIO, Tesla. Those companies were on a roll again yesterday. Worst performing industry group, the integrated oils. Continuing to downtrend. This is a group that's been leading to the downside, leading energy to the downside. And it did so once again yesterday, dropping 1.1%, even though the overall market had a pretty strong day. All right, I want to show you the industrials for a second. I'm a big history buff. Love to follow the history of the market. Seasonality is a cool tool at stock charts. So if you change this drop-down menu to seasonality, you can really find the seasonality on any of your favorite sectors, stocks, industry groups, major indices, whatever, ETFs. But here on the XLI, you can see just over the last 5 years, November has gone up every year, and it's averaged going up 5.5%, which as you look across the board, that's been the best month. But 5 years, that's pretty small sample size. I like to drag this all the way back. Go back 20 years. Look at that number there on XLI. It's been up 90% of Novembers. That doesn't mean 90% of the days in November. It means from start to finish. So you end October, and then you look at the finish in November. Did you go up or down? 90% of the time, November went up for the XLI. And the average gain was 3.4%. April is second at 2.9%. July is third at 1.3%. I mean, 3.4% going up 90% of the time. That's pretty strong historical evidence that industrials really like the month of November. And the fourth quarter in general. I mean, when you look at the fourth quarter, if you add these three up right here, that's 4.9%. That is by far the best calendar quarter of the year for the industrials. So we're in the sweet spot right now on the industrials. Now, one more thing I'll show you. Let's see what the industrials relative to the S&P 500 are doing. I'm going to put this on a line chart. And look at the industrials breaking out right now to about a 7-month relative high. And it's coming as we enter into its most bullish time of the year. So industrials are definitely a group you want to be, have on your radar right now. Maybe there's some individual stocks in there. I know we have some in our portfolios. Those are stocks I'd be considering. you can run specific scans for, say, industrial companies where the scooter has gone up so much over the last month, 2 months. I'll show you a similar scan in consumer discretionary in just a bit, how you can set something like that up. But my whole point here is that we've got industrials making a move, leading the market the last couple of days, and we know November is strong. So let's keep an eye on this group. I like some of the other areas as well, some of the other aggressive areas, but I will absolutely be following the industrials here. All right, 10-year Treasury yield. We did have the ADP employment report out this morning. It came in much weaker than expected. October ADP employment report we were expecting 650,000 jobs, came in at 365,000. September was revised slightly higher from 749,000 to 753,000. But I would say there's maybe two things that I would assume are leading folks back into treasuries this morning, which is dropping the yield significantly. We're down 10 basis points here. One being that the election is still not over. I think maybe a lot of folks that were getting out of bonds thinking, okay, finally, we're at the end, get up this morning and realize that it's not over yet. So maybe that has something to do with it. But I think this ADP employment report also has something to do with it. We've got non-farm payrolls on Friday. We have seen plenty of times where we have a complete flip from what we see on Wednesday's ADP employment report to Friday's non-farm payrolls. And so I'm not ready to write the rest of this chapter just yet, but at least early on, the 10-year Treasury yield getting hit pretty hard to the downside. And that is probably not going to bode well for financials and for banks in particular, which had started to do some pretty good things here in October. Anytime we see the 10-year Treasury yield rising, normally we will see financials outperforming the S&P 500. We'll see banks outperforming the S&P 500. And we've seen a little bit of that here in October. Here's a relative chart of the XLF versus the S&P 500. And you can see we're almost at about a 2.5, maybe 10-week high on a relative basis. So, and down here at the bottom is the correlation. So this just basically says when you compare two different assets or two different stocks or whatever you're looking at. In this case, I'm looking at a ratio, the XLF versus the S&P 500, and comparing it to the 10-year Treasury yield. And you can see we're in positive territory most of the time, meaning that whichever direction the 10-year Treasury yield goes in, generally speaking, financials do the same thing relative to the S&P. So if the 10 years going up, financials outperform. If the 10 years going down, financials underperform. That's what this chart tells us. Well, financials are outperforming, but we're taking a big hit today in the 10-year Treasury yield. So my expectation would be that financials take a hit as well. If we move on to the banks, you'll see a similar setup. Now, the TNX, if you look, actually bottomed back here in August and rose in August. And if we fast forward back to the banks, you'll see in August, we kept going lower and through September. So that initial move to the upside in the 10-year Treasury yield really didn't do much for banks. This one seems to be helping. We're moving back to the upside. Look at the relative PPO on banks on the daily chart, moving positive for the first time since back in June. So we have some positives here, but again, today's move down in the 10-year Treasury yield, if that sticks, that's going to produce some headwinds for the banks and for financials today. All right, let's move on. One of the charts that I've been talking about with our members at Earnings Beats is watching the movement lower and in our key indices. Are we going to continue to trend below that 20-hour EMA? We can't begin an uptrend until we get above it. Well, we started moving above it here in November. We broke above it. This is the S&P 500 chart. We broke above it, pulled back for 1 hour, came right back above, and then yesterday had a very strong day. And you can see that hourly PPO has gone positive again for the first time in about 3 weeks. So we started to show some good positive action yesterday here on the S&P 500. And now, we're seeing futures up. I think futures on the S&P last time I looked were up about 60. So we could be challenging that 34.25 level. Remember that level? Let me just annotate this just to refresh everyone's memory. This is where we had gapped down from back on September 8th. Couldn't get through, couldn't get through, couldn't get through, finally broke through. Came back down, held support, couldn't hold support. Well, with today's move at the open, we could be right back up at this 34.25 level. A move above 34.25 and then continuing to rally off of that would be very bullish in my view. Short term. Now, we still got overhead resistance. We're not out of the woods just yet. But I would say now that with the VIX spiking up into the 40s and reversing back down, that we could have set a bottom. And so from a daily perspective on the S&P 500, this is what I'm seeing. When I'm in a bullish market, a secular bull market, which I think we're in, that's what I've been talking about for many months. Here's that move off of the low back in, well, this would have been the low back in March. So there's our move up. What do I look for after we top? Some sort of a continuation pattern. And what I think we have now, oops. So what I'm looking at here so far is, our highs coming down a little bit here, and then our lows rising. So I see this squeezing symmetrical triangle because now we have this low established. We have this low established. Looks like we're going to move right back up here above the 20-day and the 50-day moving average at today's open. And so I think, can we make the break out of this triangle? If we get back up above about 35.20, 35.30, that would be a clear break. I mean, 3,500 would be a break, but I'd like to take out that high right there. And then, of course, we've got the September high to take out. I think in time, we're going to take them all out. But in the meantime, you have to respect this consolidation pattern, this continuation pattern. All right, let's keep moving. So I mentioned earlier that the technology group had broken below its 20-week EMA. Now, this is a weekly chart. It doesn't really post. It doesn't complete itself until the end of this week. But intra-week right now, we are below this 20-week moving average. And you can see that hasn't happened for almost 2 years. So technology has been a leader, and we've seen enough deterioration in it on a relative basis to lose its rising 20-week EMA. I'm not ready to write off the technology group because of that, but it's just telling us that we're going through a little bit more of a serious period of consolidation in technology than we've seen in the past or in the recent past. But we also know technology is on fire in pre-market action today. So I suspect we'll see that move right back up above the 20-week on a relative basis. And there's nothing wrong with the absolute chart, by the way. We took out the February high all the way back in May, maybe into early mid-June. We topped in August on an absolute basis. Right here, you can see the relative top at the same time. And we've just simply been consolidating. So I believe this is sideways consolidation. I think we're ultimately going to break out. That's the way most continuation patterns work. You break out in the direction of the prior trend. That's what I would be looking for here. And so I believe technology could lead here in the short term. I'm not so sure it's going to lead throughout the balance of the year. I think we topped on a relative basis in August. That top right there might hold through the end of the year. We'll have to wait and see. And I say that because, again, seasonality. I'm going to pull this one up on a seasonal basis and let you take a look at it. And over the last 5 years, it's been up 80% for the last 5 years in November, averaging 1.4%, not nearly as high as many of these other months. And if we go back 20 years, November, while it's been strong, look at December, the XLK. And if we add this relative to the S&P 500, December is a good month. So the fact that it's actually average losing tells us that on a relative basis, December is actually very weak for technology. And this is the way you show it. Put in the XLK and compare it to the SPX, dollar SPX. So now look at it. In November, it's been down 4 of the last 5 years on a relative basis, and it's dropped 1.5%. Now, over the last 20 years, it's done okay, 55% of the time, up 0.7%. But look at December. only, a little more than 1/3 of December's do we outperform in technology. It means almost 2/3 we underperform. And we underperform on average over the last 2 decades by 0.7%. That's our underperformance, our average. That's the worst of all 12 months. So technology's had a big run, but as we go into the end of the year, don't expect too much from this group. And it kind of goes counterintuitive, I think, because we've been following technology. It's been such a leader, but we're already seeing some of the, I'm not going to say breakdown, but we've been seeing some weakness and some selling in some big names that, we've been counting on to just go higher and higher and higher. I mean, look at stocks like Zoom and Peloton and DocuSign and some of these companies that have been really strong. All of a sudden, they're struggling. And I wouldn't be surprised to see that continue until the end of the year. And then maybe in January, start making another push towards earnings. Just a couple things to think about, that's all. But let's go back here. I want to show you the consumer discretionary because I want to kind of walk you through a segment I like to call Break It Down. So I love consumer discretionary. I've been talking about this group for a long time. We made this breakout back here in June, July, and that's really what started this relative push to the upside on consumer discretionary. So if you want to beat the S&P 500, you really have to have a number of consumer discretionary stocks in your portfolio because this has been the best performing group. So looking at this, you say, okay, what do I do with that? Consumer discretionary. Okay, great. They've been leading. Outside of buying the XLY, which was fine, XLY has been outperforming. If I wanted to look at individual stocks, what do I do? Well, I would next go to an industry group chart list that we send out to all of our annual members at Earnings Beats. Anybody that commits to us annually, we'll send this chart list to you. It's 104 industry groups. And I look at this every day. I like to see what the market's doing every single day. I can pull this up in summary mode, and I can see very quickly what groups led yesterday. Automobiles, the distillers. This is the paper group. And 3 of these names, by the way, have changed recently. This is one of them. Used to be DJUSPP. Now it's DWCPAP. So there are 2 others. I think one's tires and I forget the other one. Anyhow, but I can quickly take a look and not only see, what industry groups are doing well, but also I can quickly look at because I've got the names in the name for each one of these. I've got the sector as well. So I can quickly see there's an XLY, there's an XLY, XLY, XLY. So 4 of the top, 12, 13, 14 are in that consumer discretionary space. So what I ended up doing was going through and looking, I'll put this in name order. And so in name order, you can take a look. Here's 002, which is XLY. 001 is XLK. So when I do it here and I look at the performance, I can quickly see right down all of these consumer discretionary industry groups, what's leading. I can quickly zero in. There's autos. There's auto parts. Here's travel and tourism. There's apparel retail, recreational services, clothing and accessories. And clothing and accessories is one that I really like in terms of what it's been doing of late. Look at this move. It is strengthening to the upside. That PPO, relative PPO, now is in the positive territory, strengthening. Another group that's been strengthening for a while. Look at what is going on with specialized consumer services. Look at this triple top breakout on an absolute basis. And look at what happened on a relative basis when that breakout occurred. Money is pouring into this group. So this is an area of the market I'm interested in. So what I did is I went through all of the relative charts on the consumer discretionary, within the consumer discretionary area, and I took the ones I thought were the strongest or the ones that are strengthening the most quickly, and I put them into the scan. So it's just a very simple scan. Type is stock. The daily simple moving average over the last 20 days is at least 200,000 shares. And then I went in and I said, okay, I want to know now if I put and the group is clothing and the group is durable household products, nothing will come up. Why? Because there's not going to be a stock that's in both clothing and accessories and durable household products. They're going to be in one or the other. So when you go through and you have an or clause, you see the 2 brackets right here. So I've got these two criteria that have to be met, and all of this is one criteria from that start all the way to this double bracket over here. And this criteria is it can be in any of these groups. So you can see all of these or clauses. See all those or clauses? That's just telling me that this is one more filter. So it's a stock. It's got to have at least 200,000 average shares in the last 20 days. And it's got to be in one of these 6 groups that I deem to be rapidly strengthening. And then I added 2 more criteria. One, the scooter has to be over 80. And the other one, the scooter had to be under 60 44 days ago. 44 days is roughly 2 months, 22 trading days in a month. So I'm just saying, okay, we've seen a lot of this rapid strength come in over the last couple months when I looked at these charts. So I want the scooter over 80. And over the last 44 days, I want to see that scooter having moved from below 60 to above 80. So you can kind of picture visually what this is doing. It's looking for individual stocks that have been improving their scooter score, and they're inside of these 6 groups that are very strong in consumer discretionary. All right, I ran that scan, and this is what I got. 10 stocks. Now I'm going to go ahead and put these in to a chart list so that we can take a look at them. I'll just throw them in here. And now I'll bring them up 10 per page so I can take a look at these. All right, well, Capri Holdings is battling a major resistance area. I don't know that I'd be ready to jump into it right now. I want to see this breakout, but this is a very important level. And if you get a breakout, I mean, it definitely could make a run. I wouldn't be surprised to see a 10, 15% run if volume starts coming in and we're able to take out that June high. Many stocks that were struggling, that have been relative underperformers, that are now starting to show some relative strength, printed very important highs back on June 8th. Many stocks did. Capri is a perfect example of one, and we're right up against it. So yeah, I'd be watching this stock and knowing that it's in a strengthening group. If it makes a big breakout, I want to know about it. All right, Gildan Activewear. Well, that June high has been cleared easily. And here on the first chart, by the way, Capri Holdings, look at the AD line. It's been mostly in decline. Look at Gildan. Gildan actually was up near a 52-week high recently. So I'd be looking at Capri as one that's improving but hasn't yet become a leader. I'd be looking at Gildan as one that's already a much stronger stock within the group. Contour Brands, look at this move. Again, if you don't follow relative strength and you don't see the relative strength over the last couple of months in these groups, you would never probably come up with Contour Brands, KTB. MHK, Mohawk, just recently broke out. Look at the breakout. Yesterday, it looks like it closed above that prior high. That one's looking better. Middleby, got a double top up here around 110, 109, 110. Let's see if we can get through that. Newell Brands just broke out. Now it's got the 52-week high to deal with at 20. But look at the volume coming in. I mean, this is just a quick way. I'm going to say they're not much better. I'm going to say that they're better leaders in these groups than just these 10. But what I'm looking at are the ones that have been rapidly improving based on their scooter score. Terminix Global Holdings, nice chart. Tapestry, this is one I've actually been watching very closely. Look at the volume come in. See that? See what happened when it took out that June high? See, we failed here, pulled back. When we finally broke it, look at the move. Under Armour, I think, has strengthened quite a bit. Another one I like. Look at the triple top. It's made the breakout, pulled back, held the 20-day, and now it's moving back up again. Watch for a breakout above that earnings-related gap up. And then the other Under Armour. So there you go. There's 10 stocks. Just quickly, that's using what we do at Earnings Beats and using the powerful tools that stock charts. I can't emphasize this enough, how important this is for your solid, positive trading results in your own account. Use the power of Earnings Beats and stock charts. You'll never go back. All right. Anyway, that's break it down. Hopefully you enjoyed that. Earnings, there really weren't any massive earnings, so I'm not going to spend a lot of time on this. I'll bring up one that I thought was pretty good last night, and that was Prudential. Stock market's getting ready to open here in about 5 minutes or 15 seconds, I should say. Prudential, and I'm going to pull it up on a relative basis. It's got some work to do, but the stock is up about 0.5% in pre-market. We'll see where it opens here in about 2 seconds. But on a relative basis, it's been a leader. Unfortunately, it's just been in a bad group. So that is a problem when you have a leading stock, but the group holds it back. But let's get an update and see where it opened today. It's actually opening down a little bit. Another stock, this one was actually opening very strong, SMCI, 14% up in pre-market. This is super microcomputer, and you can see the stock up 14% right now. Been in a downtrend, though. I don't know. The gap up, if I was in it, lucky enough to be holding into earnings, I'd probably sell on that gap up. Still got a lot of work to do to take out resistance. And then maybe one more. How about MRCY? This one was getting hit in pre-market. It was down almost 10%. And the company actually beat 51 cents versus 47 cents. But it's been a relative laggard in the computer hardware area. Computer hardware has been strong, but this has not been a strong company within the space. And even though they beat, stock down 10%. Still got a lot of work to do. I would stay away from the stock. Now, after the gap down, you might see a recovery just because market makers short term are probably on the buy side because everybody's selling. So maybe we make a little bit of recovery intraday, but the overall chart here doesn't impress me. All right, let's go ahead and wrap this up, and we'll take a look at the 3 you must see. So I'm going to start off with JLL. This is Jones Lang LaSalle. And looking at the company, you can see that it also is up trying to challenge this June high, but it's pulling back down. Now, if this is really the real deal, when it pulls back, it should hold this rising 20-day moving average. Now, this is another one where it hasn't been a leader in its space, but its space is improving. So if all of a sudden it starts to show bullish characteristics and can make this breakout, it could quickly become a much more bullish stock. So I wouldn't rush in if I bought it. I think there's a lot of better stocks out there, but if I liked this one, if I wanted to buy this one, I would do so close to that 20-day, and I'd keep a tight closing stop. I wouldn't want to close below the 20. Next up, PayPal. PayPal reported yesterday, and I'm telling you, the report was not bad. I don't have the numbers here in front of me, but it was an easy beat on the bottom line. The stock gap down, but again, it's one of these stocks that's made such a huge run from 80 and change to 220 or 215 since the bottom of the pandemic, and it easily is above the February high. So it's consolidating. It's going sideways. It did not lose the September low, which I think was important. Stock had a bad day yesterday, heavy volume, but look at it rebounding today, getting back a lot of those losses, up a little over 4% today. I still like PayPal. I think as long as it holds 170 or so to the downside, I think this is one that consolidates and then moves higher. Last one is a company that reported earnings yesterday, Mosaic. Stock got hit really hard, and you can see that on these recent lows, we haven't had any closes below 17. Yesterday, we were down quite a bit, but we managed to come back up and close above 17. Today, we're down fractionally. Why am I mentioning this stock? Well, it's been a pretty good stock relative to the specialty chemicals area. And you can also see specialty chemicals, while not exactly flying against the S&P 500, seems to have ended its downtrend and just kind of sideways consolidating. But this is one of the 20 stocks that I mentioned to our members yesterday that are big November performers. So I listed 20 stocks in the daily market report. So if you didn't look at your daily market report, if you're a member of Earnings Beats, you didn't look at the daily market report, go check it out. Because Mosaic is one of the 20 stocks I pointed out that love the month of November. If you're not a member and you sign up for Earnings Beats, you can go into our daily market report and take a look at yesterday's report. So at the bottom, you'll be able to go back to the prior daily market report and take a look at it. But anyway, let me show you. So on a technical basis, I'm really watching 17. If we fail to hold 17, I think we could go back to 15. I think 15 would be a major support level for Mosaic. But let me show you the seasonality chart, and we'll wrap this up. All right, so over the last 5 years, Mosaic's gone up 3 out of 5, up an average of 7.2%, which going across the board here is the best of the whole of all the calendar months. Well, if you look at November and December, you see the strength picking up here, 65% higher in November's, 68% higher in December, 65 in January, 3 back-to-back-to-back pretty good months. And look at the 3 months, if you add up these returns, 4.1, 5.1, that's 9.2, plus another 1.5 is 10.7. And if you wanted to throw in February, that would take us up to 14.3. That's our average 4-month return starting in November on Mosaic. So this is a company that really likes to get going starting in November. I know it's weak here the first couple of days, but maybe that's even better because you're getting it, you're not chasing it after a big move the first couple of days. But if I did anything with the stock, I would still keep in mind that if 17 is lost, I would save some powder for 15. I think we broke out from that level above that June high, and we haven't tested it yet. So if we do see short-term movement to the downside, and we can already see that selling picking up a little bit, right now down 45 cents, I might even simply hold off and see if I can get it at 15. Or I think the number might be just below 1488. That's where we opened. I think that is major price support on Mosaic. So as it gets closer and closer, this is another idea. Use all the tools available at Stock Charts. All right, let's take a look, see what's going on in the market here. We've got the NASDAQ up 312. You can see on a relative basis money rotating back into the NASDAQ. I do want to just take a look at the sectors real quick and see what technology is doing. Technology actually is taking a back seat to both communication services and healthcare. Wow, healthcare leading at 4%. Healthcare providers, 6.6%, biotechs, 5%, pharmas, getting a big pop here in the healthcare group today. All right, that's it for today. I want to thank everybody for joining in. I'll be back tomorrow over at stockcharts.com for your next episode of Trading Places Live. Everybody have a great day. Hopefully see you tomorrow. Take care.